You're about to face some of the most complex and significant financial decisions of your entire career. The choices you make in the coming months can literally determine whether your concentrated company stock can meet your goal for a reliable retirement paycheck or become a source of costly mistakes that jeopardize your financial security. Most ESOP participants don't realize that they're navigating this maze of complex diversification deadlines, tax implications, and coordination challenges that might make or break a retirement income strategy. What we see is people missing opportunities with cumulative diversification limits that begin at ages 55 and then at 60. Then there's coordinating ESOP payouts with Social Security claiming strategies, avoiding the tax traps that catch even sophisticated investors off guard. Every decision you make matters. I'm Peter Newman, the founder and president of Peak Wealth Planning. We specialize in managing the retirement income portfolios of ESOP participants that are close to diversification age and retirement. What I want to do today is break down the mechanics, the timing, and the best practices to help you achieve the retirement income you've worked decades for. Whether you're concerned about overexposure to company stock value fluctuations, or you simply want to ensure you're making the most of every diversification opportunity, the strategies we're going to talk about will help you navigate these critical decisions with confidence. Let's start with the ESOP distributions themselves, the mechanics, timing, and those diversification rules. Employee stock ownership plans, they're more than just a retirement savings vehicle. They're complex benefit plans with a unique set of rules that affect how and when you can access your hard-earned wealth. If you built a significant ESOP balance across your career, understanding the intricacies of eligibility, vesting, timing, payout methods, and diversification options becomes crucial in your mission to transform this concentrated wealth into a sustainable retirement paycheck. Before you can receive distributions from your ESOP, you must be vested in your account. Vesting refers to the portion of your ESOP account that you own outright and can receive upon retirement or separation from the company. Employee stock ownership plans typically use one of two vesting schedules. There's cliff vesting, where you vest 100% after a specified period of time, for example, 3 years. Then there's graded vesting, where you might invest 20% of your account the first year, another 20% the second year, and then you are fully vested after 5 years. Your specific vesting schedule will be detailed in your employee stock ownership plan documents, or ask your HR folks. However, older plans may have different rules, especially if the plan is repaying an internal loan. That's another layer of complexity that could make professional guidance valuable. Once vested, your distributions can be paid out in several ways. Most commonly, you'll receive either company stock or cash after the company repurchases your shares. If you receive company stock, you will have the option to sell stock back to the company for 60 days immediately following the distribution. Many employee stock ownership plan companies immediately repurchase shares to deliver cash to participants. The plan determines whether those cash distributions are made as a lump sum or in installments. And some plans allow participants to choose their preferred payout method, whether to receive cash or company stock. In addition, you get to elect, do you want to have your payout pushed into an individual retirement account, a 401k plan, or receive a check that you take to the bank in cash. And we'll talk about the nuances of that in a few minutes. The timing of ESOP distributions follows both federal rules and company-specific policies, and this timing can significantly impact your retirement income strategy. If you retire, become disabled, or pass away, your ESOP account must begin distribution no later than 1 year after the close of the plan year in which that event occurred. For employees who separate for other reasons, such as job change or early retirement, distributions may be delayed, but participants must be given the option to start distributions no later than the end of the 6th plan year after separation. What does this mean in practice? You could wait anywhere from a few months to several years before receiving your ESOP payout, depending on your circumstances and your employer's policies. This timing uncertainty creates challenges when coordinating your retirement income needs with ESOP payout schedules, which could involve delays at simple retirement time of up to 24 months. One of the most important features of ESOPs, and often the most misunderstood, is the opportunity to diversify your holdings as you approach retirement. These diversification rules are designed to help you reduce exposure to company stock volatility, which means fluctuations in market value, while building a more balanced portfolio. Federal law requires that beginning the plan year in which you reach age 55, with at least 10 years of plan participation, you must be given the opportunity to diversify up to 25% of your account's value in employer stock. This 25% diversification opportunity stays open over a 5-year period, but there's intervals with your company when you can actually execute that. Starting at age 60 with at least 10 years of participation, you can diversify up to 50% of your account. And to clarify, the 25% and 50% diversification is of the shares you've ever received. If you diversify at age 55, you actually receive additional shares if you keep working at age 56, 57, 58, 59. You might even have incremental diversification opportunities up to that 25% of shares ever received, all the way up until age 60 when you bump up to 50% of shares received. Understanding these cumulative diversification limits becomes critical for your retirement planning success. Many ESOP participants don't realize they have these options or miss important deadlines because they don't understand the rules. It's important to work with a professional who can help you map out your diversification options and help you forecast what that might look like for your retirement income. When planning for distributions from an employee stock ownership plan, it's also vitally important to understand the tax implications to avoid costly surprises and to maximize your goal for after-tax retirement income. In most cases, employee stock ownership plan distributions are taxed as ordinary income in the year you receive them. This applies whether you take your payout as cash or company shares. However, if you receive a lump sum distribution in the form of company stock that represents the entire balance of your ESOP account, the tax rules become more nuanced, and this is where people miss important opportunities. You'll pay ordinary tax on the value of company contributions to your account, but here's the key advantage. You could pay capital gains tax, often at lower income tax rates, on any appreciation in share value when you eventually sell the stock. This is called net unrealized appreciation, or NUA, and it can provide significant tax savings for those who understand how to use it. You'll also need a letter from your company stating the value of their contributions to your account to take advantage of NUA. Make sure your company can provide that letter to you. To defer taxes and maintain control over your retirement timeline, you may be able to roll your employee stock ownership plan distribution, whether cash or shares, into an IRA or another qualified retirement plan. To defer taxes and maintain control over your retirement timeline, you may be able to roll your employee stock ownership plan distribution into an individual retirement account or another qualified retirement plan. This decision becomes crucial when designing a portfolio to turn your ESOP wealth into a stable retirement paycheck. Rolling over to a traditional IRA allows you to postpone and control when you pay taxes at the time you start withdrawing funds. Those taxes are paid as ordinary income tax. If the distribution check you receive is written to you directly, you only have 60 days to complete a rollover to an IRA or a 401k account, or else the entire amount becomes taxable in 1 year, could force you into a higher tax bracket, and if you're below age 59 and a half, could also result in an early withdrawal penalty of 10%. It's important to be aware of these tax rules and your diversification and rollover options. Now, here's where your ESOP can become a powerful strategic tool when it comes to Social Security. Social Security allows benefits to be claimed as early as age 62, but waiting until your full retirement age, typically between 66 and 68, results in higher monthly payouts. Delaying claims beyond full retirement age up to age 70 could increase your benefits by roughly 8% a year due to delayed retirement credits. ESOP payouts often coincide with retirement or separation from employment. This creates an opportunity to bridge the income gap between retirement and optimal Social Security claiming. You could strategically structure your ESOP withdrawals, including your diversification limits, to set aside funds to fund living expenses while you delay Social Security claims. For example, a retiring employee at 62 might use ESOP proceeds that were moved to an IRA to fund living expenses until they start drawing Social Security at age 68 or even 70. This delay increases significantly your Social Security benefits and maximizes your lifetime income throughout retirement. If you or your spouse have a pension, this adds another layer of complexity to retirement income planning. Coordinating ESOP withdrawals and pension benefits becomes crucial to manage your federal tax bracket and potentially minimize Medicare surcharges with the goal of maximizing your after-tax income. Pension benefits are usually paid as annuities, meaning steady payouts, and may begin at different ages than your ESOP withdrawals. One of the most effective strategies for tax deferral is rolling your ESOP distribution into a traditional IRA account or another employee-sponsored 401k. This rollover, if completed within 60 days of receipt, or your company pays your ESOP distribution directly to a retirement plan, allows your assets to continue growing tax deferred and avoids immediate income tax on the distribution. Once your ESOP distribution is rolled over to an IRA, you can then manage withdrawals strategically, spreading income over many years to control your tax brackets and invest with the goal to meet your cash flow needs. Another valuable strategy is considering installment withdrawals from your ESOP after it's rolled into an IRA. Spreading distributions over several years seeks to generate a steady income stream that can supplement Social Security, your spouse's 401k, annuity, or pension benefits. To keep your income low and provide opportunity for Roth conversions, you withdraw from taxable accounts first, allowing your tax-deferred accounts, including rolled over ESOPs, to continue compounding and work with your CPA and your financial advisor to see if Roth conversions make sense while your income is low. Once you reach Medicare age 65, you'll coordinate withdrawals carefully to avoid increases in Medicare premiums due to IRMAA surcharges from your higher income. Starting at age 73, when required minimum distributions from qualified plans kick in, you'll coordinate withdrawals to ensure compliance with RMD rules and avoid penalties while not generating excess taxable income. At age 73, you might draw from your taxable accounts in your Roth IRA and only draw what you need from IRA accounts that are tax deferred to meet those RMDs. High-value ESOP participants face unique opportunities and risk. One risk for ESOP participants is holding a disproportionate share of retirement assets in employer stock. For example, you have 60 or 70% of your wealth in a single company stock. This concentration makes your retirement security highly dependent on the company's performance. If the business suffers setbacks, a decline in the economy, or you're in a cyclical industry, its stock could lose value, meaning you might face significant losses, jeopardizing your long-term financial stability. To reduce this risk, it's generally recommended to diversify holdings as soon as plan rules allow, particularly when you reach the diversification events at ages 55 and 60, and especially if you have enough wealth with projections to meet your future retirement income needs. ESOP distributions, when taken as a lump sum or in large installments, could push you into higher tax brackets for that year, resulting in unnecessary tax liabilities. Think carefully about how to take your distributions. To help avoid these pitfalls, work with qualified financial advisors experienced in ESOPs, retirement planning, and tax strategies. Look for expertise in ESOP diversification rules, a transparent fee structure from your financial advisor, and someone who understands tax optimization. These professionals can help design a personalized plan along with your CPA for diversifying assets, timing distributions, and integrating ESOP holdings with your other retirement accounts. Successfully integrating your ESOP into a comprehensive retirement strategy requires careful attention to multiple areas. Understanding the mechanics, timing, and diversification rules ensures you can access your benefits when needed while taking advantage of strategic diversification opportunities. The tax considerations for ESOP distributions can significantly impact your retirement income, making it essential to understand your rollover options and required minimum distribution planning. Transforming your concentrated ESOP wealth into the goal of reliable retirement income involves navigating complex rules, timing decisions, and tax implications. If you're approaching ESOP diversification eligibility or planning your retirement strategy, it's worth considering professional guidance to develop a personalized roadmap that aligns your ESOP benefits with your retirement goals. Subscribe to this channel to stay up to date on everything you need to know about ESOPs. Schedule a free consultation with us to discuss your specific situation.